Okay, hello everybody. Thank you so much for joining us on this wonderful Tuesday afternoon in August. We have a really informative, interesting presentation put together for you today. We are going to be discussing the three fund portfolio, which is a really revolutionary way to invest that has kind of come into the world over the last 10 years or so. And we as a firm have really embraced it. It's something we love talking to our clients about. And so we have an expert here on the team to explain it all to you, and that is Chris Mamula. Chris has been an advisor on the team for, gosh, Chris, almost 2 years now, which is
Yep.
crazy. In addition to being a wonderful advisor, Chris also is an author. He wrote the book Choose FI, Your Blueprint to Financial Independence. And he is also the primary author of a very popular blog called Can I Retire Yet? So he has a lot of knowledge in that brain, and he is going to use it today to talk about the three fund portfolio. So, Chris, take it away.
All right, we're going to jump right in because we got a lot of stuff to talk about. So we'll start with our three objectives here today. So first, what is the three fund portfolio and how does this approach differ from traditional investment advice? Number two, what are the key features that make this strategy effective? So we're going to talk about how it's broadly diversified and low cost and what that means and why it matters. It's tax efficient and elegant. And last but definitely not least, it works. And that's the most important thing because we want to be growing our money and having it working for us. And then we'll finish off just by talking about how we're putting the pieces together because we're going to tend to recommend the three fund portfolio to really everybody. And we have people all over the stages of their financial journey. But your portfolios aren't going to look the same because we're going to put these pieces together in different ways to make it work for your specific needs. So let's just start with talking about traditional investment advice versus the Abundo way. So with traditional assumptions, you'll hear that, investing is complex, but you can outperform, you can beat the market. But this is hard and it's going to be complex, so you need an expert to help you. And because of that, it's going to be expensive, but you just ignore the cost because having that expert is worth it because you're going to beat the market. The Abundo way, what we're going to share with you is that that's virtually impossible, and we're going to share research that shows that. So your goal is actually just to capture the market's returns, which for the vast majority of people, if you have a appropriate savings rate, is going to get you to where your goal is, where you need to go. And because we're trying to capture the market's return, we want to minimize all investment expenses and taxes because that's going to allow you to keep more of your returns. And then you can just focus your energy on more impactful things, whether that's figuring out how to increase your income or how to budget so you know where your money is going and you can spend more intentionally, or maybe just not thinking about money at all and just, exercising or spending time with your spouse and your family or whatever is important to you. So let's just start with the idea of why do we say you should just buy the market and accept market returns? This is some pretty compelling research that actually just came out recently from Arizona State. And it showed that over the past century, only 4% of stocks accounted for all of the wealth created by the stock market, while the remaining 96% of stocks collectively matched 1 month T-bills. So what's that mean? It means like basically it would have, matched inflation for 96% of the market, while the other four gave you all of the gain. So the average stock return from 1926 to present, and this number is pretty astounding, 22,840% if you had just the average returns. But if you had the median return, meaning you took the worst stock and the second worst and you lined them up to the best stock and you just picked the one in the middle, the median stock lost 7.4% over that time. So what that tells us is that very few stocks basically produce all of the return of the stock market. And so we don't want to miss a few of those that are going to provide all that return. And the only way to guarantee you won't miss out on those stocks is to own the whole market. And this is kind of counterintuitive when you look at this because you'd think, man, with so few winners, it's got to be easy to find those and pick those. But research, and again, we're going to dive into this a little bit as we go through the presentation. Research shows that it is very hard to pick winners, and you're going to spend a lot of money trying, and those expenses that you're going to generate and the taxes trying to trade in and out are going to really eat into any returns you may build. And so it's just a losing strategy, whereas owning the whole market is a winning strategy. And so that kind of takes me to a favorite quote, and I'll throw in a couple of John Bogle quotes because I just love them. He's the Vanguard founder and a big proponent of this this approach of a broad index fund approach to investing. And what he would say is don't look for the needle in the haystack, just buy the haystack. And that's exactly what we're doing with the three fund portfolio. So let's just start. What is the three fund portfolio? And we're going to kind of start with some foundational things, and then we'll get pretty far into the weeds as we go. So no matter where you're at, hopefully you're going to have something for everybody here. So the three fund portfolio. One of the funds is a total US stock market index fund. A second is a total international stock market index fund. And then a third is a total bond index fund. So a total US stock market fund. So that's just a fund that's going to follow an index tracking essentially every publicly traded US company. So Vanguard, Fidelity, Schwab, they're all going to have their versions. And pretty much every retirement plan is going to have some version of this type of fund that's going to match or be a appropriate substitute that we can put in there. And your advisor is going to help you to find that and pick that. So you don't have to worry too much about that. I just put some examples up just to show that there is a little bit of variability, but they're essentially going to be interchangeable. Before we get too far ahead, I think it's important just to talk about what is an index. So if you put the news on tonight and you see the S&P 500 went up by 1% or down by 0.5%. So an S&P 500 is an index. It's just a collection of stocks. And if you own an index fund, so an S&P 500 fund in this case that tracks that specific index, then you would expect for the day your fund went up by 1% or down by 0.5% because it's just tracking what that index does. So again, a total market index is trying to not just buy the 500 biggest companies, but it's basically trying to buy every publicly traded company, and it's going to track slightly different indexes that try to achieve that goal. So we talked about how hard it is to beat an index approach. So there's an organization called SPIVA, and they produce, it's the S&P index versus active study. And so what this does, it looks at indexes, and then it looks at active funds that try to pick stocks from within an index and how many of them can actually beat the index. And so when you see bigger numbers on this chart, that's the percent of times the index beat the active funds. And so what you see here is as you go across at 1 year, you have a very small chance of outperforming an index. Most of the time, but not always, the index is going to win. But what happens is the next year, it's not the same fund that tends to beat the index. And so those advantages keep the index. So what you see as you go from left to right is those small chances you have become almost non-existent as you get out to 10 and 15 and 20 years. When as you go down that slide, you'll see that the index is beating over 90% across all sectors of the economy. So again, the take-home message here is we want to just buy the index, accept what the market provides, and then work on keeping as much of that for ourselves and not losing that to fees and taxes. So with the total US stock market index, again, you're going to have very broad diversification. So I mentioned there's a lot of different funds that can represent this. I chose VTI, which is the Vanguard ETF version of a total market fund, and we'll do that the same with all three of the funds. I just chose that just to be consistent. So VTI, it's a cap-weighted index. So that means it owns a percent of each company's stock proportional to the size of the company. And again, when we talk about market cap, again, if we just had a company and it had 100 shares of its stock and they sold for $10 each, that company would be worth $1,000. Now, obviously, we're talking about much bigger dollar amounts when we're talking about publicly traded companies, but that's the idea, just to kind of get an idea of what we're talking about. So bigger companies are going to make up a bigger portion of the index and smaller companies a smaller portion of the index, but you're going to own everything in proportion to its size. And that's going to give you diversification across all sectors of the economy. As you can see at the moment with a US total market fund, a lot of that's going to be concentrated in technology because those are the companies that are doing really well at the moment. But this isn't a static thing. This will change over time as the economy changes over time. Now, we talk about low cost mattering. And what does that mean? Well, let's start with this headline from Morningstar. And Morningstar's done a lot of research, and many places have. And I would encourage you, if you aren't familiar with this research, to familiarize yourself with it because it's really important to understand how important fees are. And so as this headline shows, how fund fees are the best predictor of returns. So a couple things to understand. Number one, expenses are one of the few things investors can almost completely control. With maybe the exception of some of your 401k plans may have some higher fees. And we can talk about that, with your advisor in your sessions of the impact of that. But almost always we have control over the fees. A fund's fees are, again, the biggest predictor of the fund's success relative to its peers. And again, this is a key feature across all of the three funds in the three fund portfolio, is they're going to have extreme low fees compared to their peers. So again, returning to the example of VTI, the Vanguard Total Market Fund, it has an expense ratio of 0.03%. And again, just slowing down a little bit and saying, exactly does that mean? So for every $10,000 you invest in VTI, your cost to invest in the fund over the course of the year is $3. And in and of itself, that doesn't mean a whole lot without a comparison. So let's look at if you invested $10,000 in an actively managed fund with only 1% fee, which is kind of how fees in general are presented in the finance industry, because those numbers look kind of small. And so if you had 10,000 in an actively managed fund at 1%, it would be $100. And even at that, $3 versus $100, the absolute amount isn't that impressive. But what I would encourage you to look at is you're really paying 33 times more for the active fund. So as you start putting zeros behind these numbers, if you have $100,000, now you're paying $30 versus $1,000. And if you have $1 million, you're paying $300 a year versus $10,000 a year. So those numbers get bigger and bigger as your account balances get bigger and bigger. And it's important to understand this because those fees compound over time. Obviously, I think it's pretty straightforward that the fees themselves add up over time. So if you're paying $10,000 a year on $1 million, over a decade, that's $100,000 just in and of itself. But what's less obvious is that your funds should be growing, so those fees are going to be growing, and every time you pay those fees, that's less money you have to be compounding. So if you paid $10,000 in the first year, that 10,000, if you would have made 10% in the year, would have grown to 11,000, but now that's not there. So you've lost that 11,000 and that ability for that 11,000 to compound and so on and so on and so on. And so over time, those fees just completely eat away at your returns. And if you look at 1% over, several decades, that can take away half of what you would have ended up with, all things equal, with much lower fees, which is possible with a total market fund. The other thing we like about, and these next couple slides, when we talk about tax efficiency, this really only matters in a taxable account, so not in your retirement accounts. But hopefully we're going to, all of us have some money outside of those accounts, and particularly as we're getting close to retirement and we need to access that money if we're retiring early or if we're saving for other funds like a house that's out in the future and we want to invest. It's nice to have a taxable account. And using VTI as the example, that fund has very little turnover within the fund, 2.2% last year. It has a very low dividend yield, 1.25% currently. And it has most of the dividends that it does produce are qualified, and it was estimated at 93% for 2024 when I dug into the fund. And these numbers are going to move from time to time, so these aren't static either. But it's important to just step back and say, well, what does this all mean? So when we look at taxes on investment, just like expense ratios, taxes are another investment expense that are going to decrease your portfolio return. What most people don't understand is you have a good bit of control over the tax efficiency of your investments, both by choosing investments that are tax efficient and then holding them in the most tax efficient account, be that a taxable account, a tax deferred retirement account like your 401k, or a Roth IRA where you pay your taxes prior to investing and then that money grows tax free and is taken tax free forever. Our goal is to maximize your after-tax returns. A lot of times, a lot of things are sold on the idea of not paying any taxes. And our goal is not to minimize taxes. Again, our goal is to maximize your after-tax return. If you don't want to pay any taxes, just take your money, throw it under your mattress. Don't let it grow when you won't owe any taxes, but you also won't grow your wealth. We want to grow, and some of that's going to be taxed, but we want to have it taxed as efficiently as possible. This requires really understanding how your investments are taxed. So at a high level, there's three ways. You're going to pay tax on capital gains, on dividends, and on interest. So capital gains, let's start with that. So mutual funds and ETFs can be taxed based on capital gains. And so what happens is if you buy in individual stocks for that matter. So if you buy an investment at $100, and you hold it for a decade, and a decade later, it's now worth $200, and you need that money, so you go and sell that investment. $100 is your money that you put in. That would be your basis or your principal, and that's just coming back to you tax-free. But the other $100 that you made is a taxable gain. That's a capital gain. And so because you've held it for more than a year in this example, you're going to be taxed at favorable long-term capital gains rates. And in the interim, in that 10 years in between, we weren't paying any tax that was hampering your return. So you get that full return up until that point. However, inside of a mutual fund, even if you don't sell anything, the company that's managing the fund can, and they do sell all the time. And if they do, if they generate a capital gain, again, even if you don't want that income and you didn't sell anything, that income is going to be passed through the fund to you, and so that tax burden is going to be passed to you. So you're now responsible for those funds. So this is why we really want a low turnover. And again, a total market fund helps provide that because they just buy everything and they hold it forever. And I think this is also worth touching on. So this is why we kind of hate active funds in a taxable account. But even other people will say, well, like, what if we emphasize small stocks or value stocks? Because there's some evidence for that. The problem is if you buy those in a taxable account and your small and some of the small stocks in your small stock fund do well, they now graduate. So even if you're buying an index fund that's not meaning to buy and sell, they have to sell because that small stock becomes a bigger stock or that value stock becomes a growth stock. And so now they have to sell. And so they're not nearly as efficient as a total market fund. So again, this is one of those things we go back and forth when we were putting this together, talking about what word we should use to describe this. And a total market is simple, but it's actually quite elegant, is kind of the term we came to, because I think sometimes simple means that maybe you're being lazy or you're not doing what you can to get the best results. And this is elegant because it's simple because you don't have to do a lot, but it just works on many levels, and you really have to kind of get under the hood to understand why it works. Now, another way that you're going to be taxed is on dividends. So stocks and mutual funds and ETFs composed of stocks, they're going to distribute dividends. So dividends are just another way you're going to make money on your investment. So again, when you're owning a stock or a fund of stocks, stocks are just companies, and hopefully they're going to be profitable. And sometimes they're going to pass that profit to you on an annual basis or a quarterly basis in the form of dividends. So they're not inherently bad. However, if you don't need the income, it's preferable that you don't receive the dividends. You prefer the capital gains because essentially that's a way of deferring your tax until you need it. Whereas if you get a dividend, whether you're going to spend it or whether you're just going to reinvest it and put it back in the fund, you're still going to be responsible for the tax on that dividend in a year. So again, a total market fund's dividend yield is low. And again, VTI currently is at 1.25%. So that helps make it tax efficient. That's another reason we say that these are tax efficient funds. And then when we look at those dividends, again, getting a little bit further into the weeds, there's qualified dividends and there's ordinary dividends. So qualified dividends are going to be taxed at a favorable rate, while ordinary dividends are not. That favorable rate, again, is very similar to the long-term capital gains we talked about. Qualified dividends are going to be the same. So we want low dividend yield, and the dividends we do have, we'd like it, the most of them, if not all of them, to be qualified dividends. And again, this is what we have with a total market fund. So again, just getting into the weeds under the hood, but it's important to understand that there's reasons why we say that these are tax efficient, and there's reasons why these have advantages that just build and build over time and make this work. So next, let's just talk a little bit about a total international stock market index. So very similar to a total US market, this is a fund that's going to follow an index, and it's tracking publicly traded companies from developed and emerging markets all around the world. So again, trying to buy every international stock that it can with the idea that it's going to hold it forever. And so there's going to be very little turnover. We're not trading. We're not trying to beat the market. We're just trying to, in one fund, gather these stocks together and hold them. So you're going to be able to collect the return and keep it. Again, Vanguard, Fidelity, Schwab, they're all going to have their version. And I just threw the tickers. Not that that's super important to know. And then most of your retirement plans are also going to have some version of these. And again, we can help you find that version and implement it across your plan. So you might wonder, so obviously that worked really well to index in US stocks. Does it work with international stocks? So again, we'll go back to that SPIVA report comparing different segments of the market, active funds that invest in them versus the index that just tracks those segments. And again, just like with US stocks, you see that you have a small chance to beat a index in any given year. But what happens is, again, some funds do beat it for a year, but then those same funds don't tend to beat it in the second and the third year. So again, those advantages just keep accruing. So as you go from left across all these different segments that they track with this study, you see again that you have a very slim to no chance to, over the long term, beat the index. So again, we want to just collect those returns from the index and keep as many as we can by controlling our taxes and fees. Again, you're going to have very broad diversification with a total international index. So with this, again, using the Vanguard ETF version, it's VXUS. It contains 8,634 stocks at the moment. Again, it's a cap-weighted index, and it's going to invest in all sectors of economy across the globe. Something kind of interesting, and I couldn't find a good slide to include that showed this, but we showed how the US currently is very concentrated in tech stocks. That's not the case for international stocks. The biggest sector that represents right at the moment is actually financials and banking. And so again, these things are going to go through cycles throughout periods of time, and that's why sometimes one will perform better than the other, and that diversification is what we want. So whenever different segments come in and out of favor, we're going to own whatever's coming into favor at all times. Again, we talk about low cost being a feature across the three-fund portfolio. VXUS and in general, international stocks are going to be a bit more expensive. Again, it's important to look at things relative. So yes, this is more expensive than a total US market, but again, compared to an active managed fund that tend to charge 1%, you're talking about really minuscule fees. And again, this is only a portion of your portfolio. So when you factor it all in, you're looking at very low expenses across the portfolio. Again, looking at tax efficiency, VXUS has little turnover within the fund, 3.9% in 23. And again, all these numbers kind of shift from time to time. But the current dividend yield is about 3% on VXUS. And a high percentage of dividends, again, are qualified, and it's estimated at 75% by the fund for 2024. So again, kind of looking at what in the world does all this mean? When we look at tax efficiency, VXUS with the international fund is going to be slightly less tax efficient than a total US market fund. And that's due to the higher dividend yield and a lower percentage of qualified dividends. However, if you're holding a international fund in a taxable account, in some of the markets where you're investing, you're going to have to pay tax in those countries. And so you're not double taxed. You can get a foreign tax credit, which you don't get if you hold this fund in a tax advantaged account. And so that kind of cancels out some of the advantage of a total market fund. So VXUS bottom line is still a very good choice to hold in a taxable account. It's also good in your retirement account. It also works in your Roth account. So again, this is a very kind of simple, elegant solution because with one fund, it works across a broad ways of applying it. Question we get a lot from our clients is, do I really need international stocks at all? And if so, why? And one argument that people make is that international stocks are more expensive than US stocks. And again, I acknowledge that, and that's true. But again, not that much that it's really should drive your decision. Another argument is that international stocks are less tax efficient than US stocks. Again, at the moment, that's true. Again, not that much and not enough that it should drive your decisions. But the third, and I think this is the reason we get really all the time, because US stocks have just been on an incredible run and they've been performing better than international stocks for recent memory. And so people think that US stocks have higher returns. And so while that's true recently, let's take a closer look at history. So this slide I took, and you can read this yourself. This is from Jeremy, one of our other advisors at Abundo. It's on the Abundo blog, and it's an article called The Value of International Diversification. And I really like this chart because I think a picture kind of helps to see things. So if you look at this, this kind of, I think, backs up the argument that US stocks outperform international if you're looking at this in isolation. But again, you have to really be careful when you're looking at back tests over different periods of time because you can see a much different picture. So what I would ask everybody to do as you're watching this is just take your thumb and just put it over the right hand, those blue bars, that last segment. And if you cover those up and you don't look at this most recent period, you'd probably have a hard time distinguishing. It would probably look pretty close to the orange and the blue. And that's, we'll show you that with data on the next slide. That's actually the case. And then if you cover up the next section of orange, now it's starting to look a bit more like the US is better than international. And particularly if you were looking only at that most recent period, it's even kind of looks a bit better than the period we're currently in. But again, I'd ask you to then cover that section up and just look at the first three, and you see two oranges and only one blue. And if at the beginning of that you looked at things and you thought, why would I invest in the US at all? Because international is clearly better. And if so, now take your thumb away and you would have missed out on all that US outperformance. So the take-home message here is that things go through cycles, and those cycles can last for a long time. And so you have to really be careful when you're making a decision and you're using assumptions that one is better than the other, that we're investing for long periods of time. And I would anticipate that you're going to continue to see cycles like this. And so we want to be diversified across both segments. This next slide is from the blog A Wealth of Common Sense. And again, I have the address so you can read this whole article if you want. But I really like this slide. It shows essentially what Jeremy's last slide did, just in a table form. And it kind of helps to see a little bit more clearly with hard numbers how long these periods can last and how great the overperformance can be. So again, you see that from 1970 to 78 and 85 to 88, you had a huge outperformance of international stocks. But the thing is, US stocks actually did okay in that period. And in between, there was a 5-year period where US stocks did better. And so if you would have chosen one or the other, you would have done okay. In the 90s, again, international stocks actually did okay, but the US did much better as the internet stock bubble was building up. But I think the most compelling reason to really consider if you want to not hold international stocks is to look at like that next period, 2000 to 2007. And that's a long period of time for one segment to really have very poor returns. And that's what you see with the US. For 8 years there, they were only returning 1.7% per year. So if you're drawing down your portfolio in retirement or you're nearing retirement, that's pretty impactful when you need those returns to be there. And even though, again, these tend to be somewhat correlated between the US and the international, you see that during that period, international would have kind of came through and supported a lot of your spending needs in that period and kind of bought you time for the US to kick back in, which again, they have in recent times. So really something that you want to think about is that cyclical nature of US versus international. And I think it's a pretty compelling case to own at least some international stocks in your portfolio. And that takes us to our third fund in the portfolio, which is a total bond index fund. So again, there's Vanguard, Fidelity, Schwab, all are going to have their versions, and pretty much every retirement plan is going to have some version that's going to work. This is just a fund that's going to track a broad market weighted bond index. What is different here with a U.S. total market stock market fund or total international stock market fund, they're trying to buy essentially everything. A total bond market is not, so the name is a little bit deceiving, so it's worth looking at that. So when you're talking about a total bond fund, it's really going to own U.S. government bonds and it's going to own high-grade corporate bonds that are going to tend to be very safe. So one way of looking at safe or risky with bonds is, are they going to default? And there's very low risk of that. And also, when the stock market turns bad, these bonds should not go bad because people are going to tend to shift their money here, and they're going to tend to look to bonds because they tend to do better in those periods. So these bonds tend to not be highly correlated with those other two stock funds, the U.S. and the international, while they are fairly highly correlated. So this is good to have to provide some stability. So you have something that generally is doing good when those are doing bad. What this does not include is inflation-adjusted bonds. And with I bonds, it really couldn't because they're not publicly traded. But the tips, I'm just honestly not quite sure why they're not in there. Municipal bonds is really something we don't want because they don't make sense unless you're a high earner and you're holding them in a taxable account. And then junk bonds is something, again, we really don't want because, again, we want something that doesn't correlate very well with the stocks in our portfolio. And junk bonds just are bonds that tend to produce a little bit more interest because you're taking more risk. And so when stocks go bad, those bonds tend to not do very well. So again, just kind of understand that the things that are not included in a total bond fund are generally a feature and not a bug. So that's not a bad thing, but just so you're understanding what you're owning. I think where people don't understand is there is some risk. And if you look at the line where it says average duration, the duration of this fund is 6 years. And what that means is a kind of a quick rule of thumb to think about this is if interest rates change, they're going to change in proportion to the duration. So if rates go up by 1%, your bonds will tend to drop in value by about 6%. If it goes up 2, you'll tend to drop 12. If they go up 3, they can go down 18%. And that's kind of what we saw in 2022, which turned a lot of people off, I think, on bonds because they went down at the same time as stocks. So again, that doesn't happen very often, but it did happen there. And you don't see that big of a loss. You don't tend to see that big of a loss in bonds, which tend to be more stable. But we did see it there at the same time as stocks. So it turned people off. So I do think it's worth taking a step back and just saying, well, what the heck was going on and why did that happen? So this is bond interest rates over time, and I just chose the 10-year because I could find a really long history. And if you see going back well over 100 years, there was a pretty normal range for interest rates between like 2 and 6%. Then, when the last time we had a lot of inflation, which is before many of us can remember in our investing lifetimes, there was a huge spike. And then since then, rates have just been coming down and down and down with little spikes in the interim, but coming down until we got to the pandemic, at which point they were already low. And then with everything going on in the pandemic, rates went really low. So now at that point, there was very little interest income coming from bonds, which made them not very attractive. And also, there was really little place for them to go down any further, which made them have little upside potential. So in 2021, that might have been a good time to be thinking about the risk of bonds. The problem is people are starting to think about it now after 2022 happened. And that's kind of like with we talked about with international stocks. We tend to look back when we tend to need to be thinking forward, what's going to be coming ahead. And so if you look at where interest rates are at today, they're kind of looking right in the middle of that traditional historic rate with around 4%, right smack in the middle. So they're paying a reasonable amount of interest, and they have potential to go up in value if rates drop. They could also go down in value if rates go up again. But again, we're not trying to predict the future. We're looking at having something that's not closely correlated to our other investments, and that's kind of going to provide that diversification benefit, and bonds fit the role again. And that's why we recommend this fund. Again, we talk about low cost, and again, BND you can buy for 0.03%. So again, very cheap, just like we saw with the other funds. And we talk about tax efficiency. And I will say BND or any bond index fund is not going to be tax efficient on its own. And that's because it tends to distribute its income. It does distribute its income in the form of interest, which is taxed at ordinary income tax rates. And this can be a little confusing because if you look at your fund, it's going to say you're getting dividends. But again, all that's doing is taking that interest income, passing it through as a dividend. So it's going to be an ordinary dividend taxed at your ordinary income tax rates at your marginal tax bracket. So for that reason, we tend to not like to have a bond fund in your taxable account if we can avoid it. But because we have such simplicity with the rest of the portfolio, and again, simplicity or we'll call it elegance, the other two funds are very tax efficient. So we only have one thing that is not. So we can tend to shield most of this in your tax deferred retirement accounts. So again, kind of how understanding how all of this stuff works and how it works together is why we like the three fund portfolios so much. So kind of putting the pieces together, the three fund portfolio, it's a total US stock market fund, plus a total international stock market fund, plus a total bond fund. The reasons we like it so much, it's simple to implement and to manage. It's simple to understand, which is really important because you know exactly what you have, and I think that makes it a lot easier to stay the course. It provides wide diversification because you're going to own the entire US and the entire international stock markets and a very diversified collection of high quality bonds. You're going to be able to do all of this at a very minimal cost and with outstanding tax efficiency when located appropriately. And because it is simple to implement and manage, it allows you to spend your time on better things. So I always have to throw a couple of John Bogle quotes in when I'm talking about investing. And I like this one a lot also. And he says, indexing may not be the best investment strategy, but the number of strategies or worse is infinite. And as people come in as clients and they've been with other managers and they have these complex strategies, I think we see almost all of them. So again, that kind of leads us to this simplified, low cost, broadly diversified approach. And again, the key thing is that it works. Now, I want to close with this last thought about putting the pieces together, because again, I think you can confuse simple and elegant for simplistic, and that's really not the case. A three fund portfolio is not a one size fits all strategy. Not every client's portfolio is going to look the same. In fact, they can look quite different, even though we're using the same three building blocks to put the portfolio together. So I thought it'd be good to just kind of finish with a couple of example kind of sample clients that are kind of based on people that I've worked with, kind of characters of them, just kind of simplify and anonymize it. So first, let's just look at a couple of young super savers. So we have a two income household. Both of them have very stable careers. They have a high savings rate. They could essentially live off of one of their salaries and they're saving the other. They have a fully funded emergency fund, so they have some cash reserves. So there's really no chance they're going to have to sell stocks if the market's down. So they have a very high risk capacity. As I talk to them, as I look at their risk tolerance questionnaires, they're comfortable with volatility. They understand that this is money for far in the future, and because they're saving so much, if the market goes down, that's actually the best thing that can happen to them because they're buying more shares on sale. So they're all in on this. So they have a very high risk tolerance. And as we talk a little bit, and I present the data that I just presented to you on international stocks, they're still just more comfortable investing in the United States, and they have less conviction with international stocks. But after talking, they agree that they should have a little bit at least of exposure there. And so their portfolio might look like 0% in bonds because they don't really need them. And because they're more comfortable, maybe we might go 80% in a total US market and 20% in an international market. And then we just kind of figure the best place to hold them across their portfolios, implement it, automate it, and then we move on to bigger and better things. We might have another person who's like a mid-career individual and they're on track, but they're anxious. So they only have one income in their household. They're still good savers, saving 25% of their income. They have a stable career, but again, not quite as they don't have that redundancy of having a second career to support them if something happens. So a little bit more risk there. And they still have a nice cash emergency fund, so they shouldn't have to sell stocks. So they have a high risk capacity, maybe not quite as high as that previous household, but they shouldn't need to sell. But as we look at their questionnaire and we talk to them, this is a newer investor. They're kind of nervous. They don't like this idea of volatility and potentially seeing their account values go down. And they're just nervous. So we say maybe they have a medium risk tolerance. And as we talk, they just really haven't thought much about US versus international. And they say that, they came to us and they trust us and give me the standard Abundo recommendation for US versus international. So their portfolio might be 30% in a bond fund. And then of the rest of the 70%, we just divide it between US and international. We say 70% US, 30% international, divide that up, figure out the best place to hold each of those, again, automate, and then just move on. And we don't really have to think about it for a number of years until they're ready to maybe get closer to retirement. And then our last case, we have somebody that's preparing for early retirement at the age of 55. They have a low withdrawal rate in retirement, so about 3% of their portfolio they're planning on spending, which if you're looking in right capital, that's going to correspond to a very high success rate. They're in good shape, but they're planning to live off their portfolio exclusively. They don't plan to do any work, and they have about 15 years until Social Security kicks in because they're planning to wait until they're 70. And so they're going to have to live off their portfolio. So because they're going to have to live off of that lowers their risk capacity because they have such a withdrawal rate, I call them maybe like a medium to high risk capacity. Now they're experienced investors, but they're very nervous because they're entering retirement. They've always been savers. They've never spent from their portfolio. And they're kind of nervous about this whole idea and they're very averse to loss. So I'd put them in the low to medium risk tolerance. And so we're kind of putting these pieces together. And as we talk, they're comfortable with international stocks. Again, they're a bit older. They've been through some of these cycles that we talked about. And they're actually nervous about US stocks because they've seen how well they've done. They realize that they have a lot and it's outsized in their portfolio. And they might want to not have so much going forward. So when we look at their portfolio, instead of looking at cash as their emergency fund, we're going to put a couple of years where it's very liquid, where it's not going to have any of that volatility that's possible with a total bond fund that we talked about. So we're going to set that aside and somewhere where it just should match inflation, maybe a money market account or a high yield savings account or some short-term bonds. The majority of their safer bucket is still going to go into a total bond fund because that should provide a little bit more return over time. And so we're going to have an additional 12 years of their expenses in bonds, which is enough to get them through to Social Security. So in an absolute worst case scenario where stocks just do horrible, they shouldn't have to sell them when they're down because they can get through till their Social Security kicks in, and that's going to provide a lot of income. And so that means there's really not much risk with their stock portion. So they can still have 55% of their portfolio in stocks. And again, because they like international compared to US more than most people, we're just going to say, let's just weight it the same as what the market would be weighted, which is about 60% to the US and 40% international. And so we do that. And again, kind of set it and forget it and go on our way. So very different portfolios for those three different people, but we're again using just the same three basic building blocks to implement them. So again, that we talk about that elegant solution and not oversimplified where it's one size fits all. So just kind of summing up our key takeaways. The three fund portfolio consists of a total US, total international stock market, and then a total bond index fund of high quality US bonds. It's a very elegant solution to build an investment portfolio. The three fund portfolio is simple, but it's effective because it provides broad diversification at very low costs and with tax efficiency. And the three fund portfolio can be customized to meet the various risk tolerances and capacities and the needs of each unique individual or household. So we can kind of match it up to so it's going to serve you and work for you. And that's kind of what I have. I'm happy to take any questions. And before I do, I just want to kind of share that we are going to have our next webinar in September about education planning. So, Eric, do we have anything?
Yeah, thank you, Chris. We wanted to make sure to leave a lot of time for questions because we know there's a lot of interest in this subject. So if you have a question, there is a Q&A feature at the bottom of the Zoom screen. Go ahead and ask your question and we will take them as they come. And Chris, we did have a question come through while you were presenting, and that was for somebody who wants to still like pick their stocks, right? They want to buy and sell individual stocks. Is there a percentage of someone's portfolio that you would recommend is kind of a safe, corridor to do that in?
Again, kind of just I think that's customized to each person because the kind of the tighter your margins are, like if you're just kind of meeting it with your plan, then if something goes bad and something goes to zero, which is possible with an individual stock, then that's more risk for you. And if somebody has more leeway, then they have a little bit more risk tolerance. I think the question I would ask is like, why do it anyway? Because the odds of success are just so low. And so I think like certain people say if I limit it to 5% of my portfolio or 10% of my portfolio, there's really no downside risk because if they can afford that, it's not going to break them. And I think my question, particularly for younger people who are just starting investing and aren't as clear, is what if you get it right? And what if you outperform? What if you bought ARK ETF a couple years ago or something that just went through the roof and you think you're smarter than you are when in reality we kind of got lucky, which is again, when we look at those stats in 1 year or 3 years, it's possible to get lucky for a period of time, but it's really hard to sustain that over that 10, 15, 20 years. And so what if you got lucky, but you thought you confused that for being smart and making a really good decision, and then you double down or triple down on that decision? It's a lot harder to do. So again, just have a simple strategy. I think it's easier to follow behaviorally, and you don't kind of get caught up in that.
Next question is with respect to that one of the very first slides, the 4% of stocks realizing basically the entire stock market return. Is that 4% the total number of stocks over the long run, or is that 4% of the stocks in like 1 year?
Over the long run. Yeah, that was over almost a century. I think it was from like 1926 to 2023, I think was the period in the study, just off the top of my head, but basically a century.
Perfect. Okay. One thing I want to add as we're collecting more questions here is, all of you are very familiar, obviously, with our model here at Abundo, where we charge a flat monthly subscription. We don't take a percentage of your accounts. We don't earn commissions. And I think this is a controversial statement, but I think that the kind of the dirty secret in the industry is that most financial planners themselves invest in indexes. I've seen this throughout my career. They will recommend a client goes into a 1% portfolio, and they themselves are putting their own money into the S&P 500 index or something equivalent. And obviously that always rubbed me the wrong way, which is in part what led me to found Abundo. But I think what's worth considering just for the audience is, we are a team of 9 financial planners here with no incentives other than finding what we believe to be the best investment strategy for you. And ultimately, you're free to do whatever you want, but we just have so much conviction that this is, as Chris laid out, the best way to invest for a myriad of reasons. And so I think it's fun to kind of poke holes and be like, well, what about this and what about this? And ultimately, like, we're on the same side of the table as you, right? We're investing into these 3 funds with you. So I think it's worth reminding that because we're the only ones, as far as I know, in the industry, right? That's doing it this way. So, meaning charging a flat monthly fee and not, putting somebody in an expensive portfolio. Okay, another question. This might have been a continuation of the last one. So that same quote about the 4% of stocks. I'm sorry, this one might need to be reworded because I'm not seeing a question here. So um, we'll let that one come back to us. Okay, another question we have is, and I'll take this one, Chris. So question about we've been an Abundo client for a long time. Thank you. And our portfolio essentially is invested in a mix of low cost indexes. When does it make sense to shift that down to the three fund portfolio, or does it? And so yes, when we started Abundo, how we put together our recommendations was we basically picked a large cap index, a small cap index, a international index, a real estate index, and we built a portfolio that way of 9, 10, 11 indexes to create that diversification. And then a few years ago, advisors like Chris, advisors like Olivia and Jeremy joined our team, and they brought me a ton of data and a ton of evidence that said, hey, we don't really need to do this. We can actually accomplish the exact same results of diversification, of low cost, of performance, of risk. We can do nearly identical with just three funds. And for me, it was kind of like a mind-blowing thing. And after we dug into the data and I validated that, we decided to shift our recommendations for clients. But for those of you who have that old portfolio, it's still an awesome portfolio. Obviously, there's nothing wrong with it. And so I would say shifting to it would be if you can do it in a way that is minimally impactful. So if you're in a retirement account, a Roth IRA, a traditional IRA, really anytime is fine to do that. If you're in a taxable portfolio, so there's going to be taxes, we would want to work together to just make sure we're being very tactical and smart about generating gains. So if there's a good year to do that, it might be worth generating those gains to get into the three fund portfolio. Otherwise, if it would be disadvantageous to you, then we would just wait until a better time and rebalance via the other portfolio. So hopefully that answers your question. If not, we can take it offline as well.
If we are waiting on a question, Eric, if I can toot your horn, because I don't think you don't like to do it yourself, but I will just share that when Eric and I first met, I talked to him, like he used to like to say that this advice only had no conflicts of interest. And I pointed out to him that everything has conflicts of interest. And I didn't like him saying that. And because I think like even with people that just have people pay for advice, there is a incentive to make things complex to keep people being a client. And we talked about that. And to Eric's credit, like when we presented him with, I don't think that that's what Abundo was doing, to be clear with that last question. But when new advisors came on and we presented that evidence that we think we could do this even simpler and be even as effective, if not more effective, and we don't need to sell any complexity, we can make our value in other areas. And he was totally open. And that's kind of, we're always looking to get better with Abundo. And that's what drew me to work here. And so again, that's to toot Eric's horn, but he's constantly learning. We all are constantly learning and trying to improve and making things as simple and keep things as affordable and allow us to scale and help more people to achieve this model. So that's all I wanted to say.
Yes. We did get another question come through. So if you move into the withdrawal phase, is there an advantage to having more growth/size differences in your indexes to sell what is up rather than the total stock market index as a whole? So, if you've got the large, mid, small, you can be really strategic about, hey, let's sell the biggest gainer versus just, hey, you own everything.
Yeah, and so again, I think that goes back to that John Bogle quote that this is not the necessarily the best approach, but there's infinite amounts that are worse. So I think that is a reasonable approach. That's kind of what Abundo was doing. Again, it's nothing unreasonable about it, just to slice into smaller segments of the market, like value versus growth versus blend, and small versus medium versus large, and it lets you do that. The problem is the total market is really tax efficient. So when you're looking at a taxable account, you can hold that one fund and you have everything there. Whereas if you're having these little segments, it's less tax efficient. So now you're taking up space and it just makes it more complex. So you're trading off, I guess, there might be an advantage to slice and dice, but you know it's going to cost more, you know it's going to be more complex, and we know it's going to be less tax advantageous versus we know with the three fund portfolio, it's going to be cheaper, it's going to be simpler, it's going to be more tax efficient. And there's also a chance that that could do better. We just don't know. So we're taking the things that we know and focusing on that versus the things that may work. But it's not a completely unreasonable approach, but it just adds complexity and cost and most likely loss of tax efficiency.
Yeah, and I would add to that if you are in retirement and you're selling investments to create income, we'll probably someday have a webinar about that because we do have a bucketing strategy that is designed to be efficient in how we're taking the withdrawals. And so it wouldn't be just, hey, peel off the top gainer. It's a bit more nuanced than that. So for what it's worth. Okay, a couple more questions came through. Is there a good place to see back-tested data for the three fund portfolio relative to other strategies?
I mean, I know we internally, I don't know, Eric, if we are able to share that, but I know like we internally, so Andrew, I know has done some testing and it's shown that it's very comparable. Again, the thing with a three fund portfolio is you kind of know what you're getting. You're getting the market's return. And depending on how you allocate it, how much is the total US market, how much is international, how much is bonds, that's going to be what dictates your return. So again, the thing to be careful about when you're looking at back testing is what happened in the past doesn't necessarily what's going to happen in the future. So if you look back at the last 15 years, you shouldn't own any bonds and you shouldn't own any international stocks because US stock market has just been on absolutely on a tear. But that doesn't mean that that's a good strategy moving forward. So you always have to be careful with back tests.
Another question came through. I will take this one, Chris. Can you explain more about why the timing of this moving from the kind of call it the older Abundo portfolio, the 11 indexes down to the 3, why the timing of that doesn't matter? The timing of that doesn't matter because the performance is the same, the risk is the same, the diversification is the same. Like they're the same portfolio. It's just the three fund portfolio is compacted. And so, if you were to move into the three fund portfolio, it's not like you're missing out on potential gains or you're selling low or selling high. You're just moving into a different portfolio. So that's kind of why it doesn't matter where the only complexity is if you're doing it within a taxable account. That's where we just have to be a bit more cautious. So hopefully does that explain that, Chris?
Yeah. And
Okay.
just full disclosure, in my own personal account, I kind of used to do that slice and dice approach. If I was starting over today, I would do just the three fund portfolio, but I do have some taxable things embedded and it kind of adds some complexity. So I'm unwinding my own personal portfolio. I would love to have the three fund, but I actually have something similar to the older Abundo portfolio in my own personal life, just to be fully transparent for that reason, that if there's tax consequences, it's not killing you by any means. It's not tremendously more expensive by any means. It's a fine portfolio. It's just the three fund it makes it simpler over time.
And I think that the simplicity to what you said, Chris, is really underrated for clients of mine, clients of Lori's who have moved into the three fund portfolio. Everybody has been thrilled. They feel lighter. It's like spring cleaning. It's like this is so much easier to understand and simpler. And I think it's almost empowering because this investment does this, right? This investment does this, and this one does this. And that's a really cool thing if you know kind of what you're investing in versus if you have those, 9, 10, 11 ETFs, it's hard to kind of keep track of like what each one is doing and why it's there. So I like that aspect of it.
Agree 100%. Yep.
All right. Thank you, everybody.